Most franchise owners are missing one of the easiest tax loopholes out there, and it's costing them thousands every year. What if I told you that you can legally rent your home to your business, pay zero tax on that income, and your business gets a full deduction? This strategy is called the Augusta Loophole, and yes, it is totally legal under the IRS tax code, specifically Section 280AG. It lets you rent out your personal residence to your business for up to 14 days per year. And the best part, that rental income is completely tax-free. For franchise owners who hold meetings, team trainings, or even record content at home, this can be a game changer. Here's how it works step by step. 1, you own a business, ideally an LLC or an S Corp. Now, the good thing about being a franchise owner is you have a business. Most likely you're set up as an LLC, you might be set up as a corporation, but either way, the Augusta Loophole can work for you. Step 2, you use your home for legitimate business meetings. Think planning meetings for your franchise. It can be related to the following year, strategic planning going forward. It could be for hiring, expanding your team, really anything that is a business purpose. Step 3, you charge your business a fair market rate for the rental of your home. You would charge like what a hotel or a conference space or a personal rental would cost in your area. Step 4, your business writes it off as a deduction, so you personally don't pay a dime of tax on that rental income, again, for up to 14 days per year. So you're moving money from your business to yourself, totally above board and keeping more of your income. Let's look at some real numbers. One of our franchise owner clients held 10 meetings at home throughout the year. Based on the local hotel rates in his city, we valued each meeting at $1,200. 10 meetings times $1,200, that's not even using the full 14 days. Just for 10, that would be a $12,000 deduction. The business was able to deduct the $12K as a rental expense, and the client received 12 grand tax-free. Now, this client was in the 30% tax bracket, so they saved $3,600 in taxes in just a single year. Now let's go even deeper. We helped a multi-unit owner in Florida implement this exact strategy. After calculating the fair rental value and structuring a rental agreement, we were able to save him $9,281 in 1 year, $9,281. We documented every meeting, calculated the fair market rate, and made sure that everything was in writing. It was seamless, and the results were huge. Over his 10-year franchise term, that could easily amount to $100K or more in taxes saved. He told me, I had no clue this was a thing. My CPA never mentioned it. You know, we hear that a lot, where CPA didn't mention these things before. This one strategy alone freed up cash to reinvest in marketing for his second location. And that's the key. Tax strategies like this give you more cash to grow your business. Now, I know what you're thinking. Is this some gray area loophole for the rich that's not really going to work for me? Is my franchise too small? Absolutely not. You don't need a mansion. You don't have to be a C-suite executive. You just have to have a legitimate business and use your home for rental meetings. This is IRS approved, written into the code in Section 280AG. The key is proper documentation and pricing. Let's talk about common mistakes. Here's where people mess this up. How to avoid these traps. 1, trying to do this without a rental agreement. There needs to be a written agreement between you and the business agreeing that your home's going to be used for meetings for the business. Another big mistake is trying to charge too much on the daily rent. You can't do 3, 4, 5 grand a day. You'd be surprised what people would like to do. It has to be a comparable market rate. Another big mistake is, okay, you've got the rental agreement, you use a fair rent amount, but you don't document what you did. So you don't have like minutes that you kept to record what was discussed, what was reviewed, who was in attendance. You don't have that. You really don't have anything to back up the fact that a meeting ever occurred. So you have to have a log of events. Mistake 4, going over 14 days. This loophole is written in a very specific way. 14 days, that's it. If you were to rent your home to your business for one more day, for a 15th day, all the days are out. You don't get credit for any of them, no deduction. Now, you get all these things right, you don't make these common mistakes, then you are golden. If you get them wrong, you could trigger an audit. So it's really important that you do these things correctly. So if you're a franchise owner and you're not using the Augusta loophole, you're leaving a serious amount of money on the table every single year. Imagine what you would do with an extra $9K a year. You'd reinvest in your business, pay down debt, or finally take that vacation. So if you want help implementing this into your franchise, drop the word Augusta in the comment section and a member of our team will reach out as soon as we can. And don't forget to subscribe. We drop tax tips for franchise owners all the time.